Hello everyone, welcome to this tutorial. It's a very quick tutorial on the differences between a normal ETF or a normal index fund and a smart beta ETF or index fund. All right, these are all phrases that get tossed around a lot, and there's a lot of things that are wrong in the industry and they're almost just designed to confuse you. So I'm hoping to answer some of those questions for you and make these things easier to understand. So first of all, we know that most exchange traded funds or ETFs are index funds. So index funds. Now index funds, as you know, if you've watched all the other videos on our website, index funds simply track an index. So like the USA's S&P 500 or the FTSE 100 or in Australia the ASX 200, an index fund is just designed to follow whatever that market does. So in this instance, if we have, say, this blue line is the market or the index, this is what an exchange traded fund would look like that tracks that market or index. So an index fund ETF, which is the way they started, would just track that. There would be some slight differences for fees and costs that are incurred by the ETF relative to the index, but you would typically see a very tight line like that. So that's an index fund, and they've been very effective over a very long period of time. What's a smart beta? And as you can see here, I've done smart with some little marks around the outside. What's a smart beta ETF? Well, if you've done any sort of academic study on finance, which is so much fun, you can recognize that this word beta is a name that we use a lot in finance, and what it is it's a measure of risk. Mostly, it's a measure of risk. So we say a beta of 1 is the market beta. So the market as a whole has a risk weighting of 1. Let's just say it's a risk weighting. So it has a risk weighting of 1. If something has a beta of 2, we can say that it's got a higher risk rating. So this is great writing right here. So if there's a beta of 2, I hope you can see that. If it's got a beta of 2, it's a higher risk weighting. So if the market fell 5%, a beta of 2 would mean that it falls 10% or twice as much, so it's a higher risk rating. And if it's got a lower beta, say a beta of 0.5, that's only half the risk of the market. Now, why on earth am I telling you about that? Because that's exactly the reason why smart beta funds have come around and why smart beta ETFs are growing around the world. All a smart beta ETF does is tries to minimize the risk and maximize the return. Sounds pretty cool, right? Like, if only we could have less risk and make more money. Why not? Well, unfortunately, most of them don't work. In fact, almost all of them don't work. And all they're trying to do is to give you a different outcome when you invest in their fund. So whoever runs these ETFs, these smart beta ETFs, are trying to give you a different outcome. So let's say there's a smart beta ETF that focuses only on companies, it only buys companies with high dividend yields. Well, that would be a smart beta ETF that's focused on income, and they would use some sort of rule, which is why these are often called a rules-based ETF, is because they use rules to pick shares or to pick bonds or to pick property securities or to pick cash trusts that are different to what you get in a broader market. So what would it look like? It might look like something like this. So you can see that the line deviates from what the market is doing. Now, this is just an example, but there are so many different smart beta ETFs that I couldn't even explain a handful of them in this tutorial. Most of them are minimum volatility. So what they're trying to do is they're trying to lower the volatility, which is the random ups and downs of the share market. They're trying to lower the volatility of the investment portfolio. So instead of, say, like the sweeping up and downs, what they're trying to do is they're trying to, I suppose, do something like this and try and cut out the bad stuff on the downside while also going up over the long term. It's kind of like an old school hedge fund, but the difference is that they're very simple, and they might just say, smart beta might just pick companies with a high dividend yield, or they might pick companies with a low PE ratio. Very simple stuff. That's what a lot of these smart beta ETFs do. And the big picture is that most of these smart beta ETFs have come around because the companies that issue them, the big finance companies that issue them and to that run these smart beta ETFs can charge a higher fees because presumably, hey, we're trying to do something that gives you a better return, therefore we should get more fees for it. Most of the time they don't work. So when you're considering one of these things, I would ask that you go back, and in Australia you can go back and you can look at the product disclosure statement or the PDS, which is available on whoever runs this smart beta ETF. It's on their website. Have a look at it. Have a look at the strategy. Don't just look at the performance and say, hey, that looks like it's done well in the past. Maybe it's going to do well in the future. Actually have a look at it. Try and understand the strategy. And also, when you do look at performance, remember that most of these smart beta ETFs are really new. So what they would have done is they would have given you hypothetical returns or back-tested returns from the past. I won't go into it now, but a lot of those back-tested results probably won't work in the future. So it's probably best that when you do look at these, you're really skeptical of all the returns, because at the end of the day, I mean, hey, if they've managed to find a strategy that beats the market, that offers lower risk, why are they offering it to you and I? Why don't they just do it themselves? So they're either wanting more fees, or maybe it's not going to work as planned. Ultimately, you can tell that I'm very biased towards this, but just be really careful before you buy into one of these and make sure you understand the strategy and the risks as well as the reward for doing so. If you have any questions about smart beta ETFs or rules-based ETFs, be sure to head to the Rask Finance website, where we've got more tutorials just like this and you can ask some questions.